by the stage we start looking at companies, which is Series B onwards, there's a lot more of data for us to chew on. The product market fit is already established. Even the go to market is already established to some extent. What we need to then figure out is that this current set of team can build upon this platform that has been set up to grow 4x, 7x, 10x from the current levels in the defined time frame.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Ruchir Lahohy with us. Ruchir is a managing partner at MegaDelta Capital, investing in mid-market Indian startups. In this episode, we talk about Ruchir's story and how he started investing, how they helped set up NEA India, origin story of MegaDelta Capital, tracking India's growth story, how does early stage investing differ from growth stage, exit options available to founders, and lots more. So without wasting any time, let's dive straight in. Hey Ruchir, so good to have you on the VC 10X podcast. How are you doing?
Very good. Thank you, Prashant, for having me here. It's a pleasure. Hopefully, we'll have some fun over the next 30, 40 odd minutes.
Absolutely. It's a pleasure having you on, and we'll be going through a lot of things about growth equity, something that we haven't covered a lot on the podcast yet. So before we do that, can we first have your story and how you started investing?
It's an interesting story, I guess, and I'm biased for sure. But essentially, a Marwari by background, so accounts, maths was what I was always good at. Post MBA, I joined a company called TCS, the largest IT services company in the country. And in TCS, last year and a half, I spent doing M&A for them. So essentially, a buy side role where I was looking and taking a very long term view on which assets to buy for TCS. Working with a cross section of teams, etc. So that got me interested into investing per se. Uh, and then I did sell side research as well, which further confirmed the fact that I wanted to be on the buy side private markets. And then I joined ICICI Venture. This was way back in 2007. They were the largest domestic PE firm at that time. So I joined at ICICI Venture in the team that was being led by Bala Deshpande. She continues to be my colleague all the way 15 years out at NEA and then MegaDelta as well. So it's been a interesting 15, 16-year odd journey in private market investing in India.
Right. That's very interesting. And I also learned that you were involved in setting up NEA India, right? And NEA is like one of the most reputable funds, right, across the globe. So, what was the goal with setting that up, and also what was the experience setting it up, right?
Yeah, I guess that was a very transformative phase for three of us, Bala and Tarun, my batchmate and colleague who joined soon after, and myself. I guess when we were at ICICI Venture, we were doing and looking at investing from a lot more of India only lens. When the opportunity to set up the India platform for NEA came about, Bala was the one who got hired first. She was the general partner equivalent, and I got to apply, meet some fantastic people, and then finally decided to join NEA, realizing that probably NEA like investing is very far away from what we are doing in India, but at least that would be more future ready investing of some sorts. So when we joined, this was the time when cloud was just about picking up, 2009ish, right? And enterprise tech, big databases, etc., were just getting built out and formulated in the US, while in India we were very, very far behind. So it was a great learning curve for the three of us as we understood and learned IP-driven investing, as is the NEA style, but incorporated that to essentially set up a distinctive identity and a thesis-driven investing for NEA in India, because we couldn't have done the similar or same kind of investing that NEA does, because that ecosystem is not there. The kind of entrepreneurs, investments required were not there in the Indian context. So we picked up the nuanced investing style and applied it to India in the context of Indian businesses, Indian ecosystems, and build that portfolio. I guess in the early days, nobody even had heard of NEA. NEA is a very, very quiet brand name, even in the US, even though they are probably the largest VC funds, but they are a very, very quiet VC fund, unlike their other peers in the US markets. So it was the first few years was about building up the NEA brand as well. So it was not just about uh, taking an NEA platform and just duplicating it in India, but was actually setting it up from scratch, which was also exciting. I guess we learned how to build the practice, expanded that practice, grew it to the size scale, uh, which was very productive as an experience, if I may call it that, heartening, because we were really living through the India story.
Right. Yeah, certainly, and that's very interesting. So that's I believe how you got a taste of the Indian market in the like startup investing space. So and then you got on to building Mega Delta Capital, the three of you, right? Uh, so what was the initial investment thesis like? Was it the same as what was with NEA India, or was it different over here?
Sure, and I think I'll take you to a little bit of story around how MegaDelta got set up, because that context setting is important. At NEA, we were investing out of a global fund, right? And NEA had two other geography practices. Most of the other practices were inside the US, healthcare, tech, and so on and so forth. That were China and India. Uh, at some point, NEA decided to move out of the international footprint, which is both China and India. And the China team spun out, carrying some of the China investments with them and setting up their own practice. We borrowed that from the China team and spun out with our Fund One, which is essentially a portfolio that we acquired that we had built for NEA. So we got 7 institutional LPs to come in and give us money for that. So our Fund One is essentially that bunch of portfolio companies that we had anyways invested for NEA that we continue to manage for the new set of LPs. The Fund Two, which is what we are in the process of raising, hopefully over the next few months, we should get a first close done, is uh, is essentially a $300 million target size, mid-market focused fund. From a sector thesis perspective, it largely remains the same. So we will continue to back three large spaces: consumer across the digital and not so digital, healthcare across pharma devices, services, health tech, and technology, including enterprise SaaS, B2B, or all of the dash tech plays like edutech, fintech, and so on and so forth. So these three broad spaces is what we would look at and continue to look at. What would change from NEA to now is essentially at NEA, we could have written a $2 million check or a 50 million, $60 million check, given that we were operating out of a $2.5, $3 billion global fund. I guess with our own $300 million odd fund size, we would keep the tram lines a little narrower. We'll probably start off at $8, $10 million odd and go up to $20, $25 million of investments in a single company, not more than that. So typically end up with 12, 15 odd portfolio companies uh, in that fund vintage.
Yeah, yeah, certainly. And I would like to understand like why this focus on mid market growth equity, because you've had experience in early stage as well. So why didn't you go for early stage and pick this mid market growth equity kind of fund?
Yeah, that's a very interesting question, and I think as we spun out of NEA, at NEA, I personally had done a seed investment as well as been part of the team that wrote a $50 million check, a classical growth or late growth as well, and all the stuff in the middle, Series A, Series Bs, and Cs. I guess what when we sat back together as a team, Bala, Tarun, and I, what we realized that the part that we love the most is about taking companies from a stage 2 3 to maybe a 7 8, right? Obviously 10 being a full blown large enterprise. And we believe that the experience that we have, the networks that we have built, is more appropriate in handholding companies in this phase of the journey, which is equally tricky, if not more. Since you are from India, it's very easy for companies to survive at a subscale level for a long, long time, given the cost economics in India, right? So therefore, to break out of that 2-3 stage to get to a 7-8 is a different kind of a challenge in itself. I'm not saying that from 0 to 1 is less challenging, more challenging, but this one is a very different challenge and probably requires very different way of approaching investing as well as company building, which is what we have enjoyed the most while building it out at NEA as well. It also happened to be the case that this currently is the space which is probably the least competitive as well. Not many funds are there. The funds who are there are very, very collaborative. I would know all of them. They would know us quite well. We might have different approaches to investing, but at least broadly, the ecosystem is very, very supportive. But finally, I think the main thing was that we have shown through our company building skills at NEA and now at MegaDelta that this is the space where our value add can be the highest, and therefore, since it was matching with our aspirations, it was an absolute great fit.
Yeah, absolutely. And I would like to have you contrast early stage investing, like up to maybe Series A, to what you're doing, Series B, C. So, how does your approach to investing differ while you're going earlier than when you're going at Series B or C stage?
Sure, and it's very interesting, and I have a whole lot of friends as well as business colleagues in the earlier stage ecosystem. I think the approach towards investing is very, very different. In the early stage, especially pre-seed, seed, you are basically looking at the founder or founding team and the size of the market opportunity and saying whether this team can build something in that market opportunity. The hope is that the founders would fiddle around and find out something that is relevant and would make business sense. And therefore, by design, you would try and take a lot more bets as long as you believe the market opportunity is right. So, for example, if it's fintech, you would try and take 3-4 different kind of approaches to that same consumer fintech market, hoping that one of them would work out. The founders would figure out the product market fit, will be able to grow the companies, and so on and so forth. Uh, this this probably is the most fundamental difference, I guess. By the stage we start looking at companies, which is Series B onwards, there's a lot more of data for us to chew on. The product market fit is already established. Even the go-to market is already established to some extent. What we need to then figure out is that this current set of team can build upon this platform that has been set up to grow 4x, 7x, 10x from the current levels in the defined time frame that we have in mind. Right. So the kind of assessment that we need to have gets to be uh, a lot more of a combination of data, market data, company data, competitor data, plus intuition as well. The founder to product market fit, if you were to call it, or founder fit, if you were to call it, the ability of the founding team uh, to even hire better than themselves, uh, uh, or to build or pivot to some extent based on whatever the market feedback is, or the essentially the vision that is there on the product or technology roadmap side, which will enable the growth curve to remain steep over the next 4 or 5 years. Things like that would essentially get to play a uh, uh, lot more in our investment discussions, decision making, uh, then it would have been possible in the earlier stages because there's no real data to speak about in earlier stages. A lot of the other things also start coming to play. We have seen so many companies scale up in different sectors. So, what kind of a sales structure, org structure works? What kind of processes that we can help companies undertake to make sure that this thing scales up in the right way in, say, tech companies. uh, what is the architecture that is there? Can this be something that can scale 20x 30x in a short period of time or not? So some of those other things come into play which are otherwise not usually a discussion point, especially at pre-seed and seed. At Series A, they still are a discussion point, but probably not as intensely because you've just about achieved a product market fit probably. So therefore, the whole lens changes. The other lens, at least we bring in very very sharply into evaluation of opportunities, is on exitability and the opportunity of or the potential to have multiple exit paths be available uh, uh, in the next say 4 to 5 years time frame, which is when we would typically look at getting out of companies and monetizing the value creation that has happened. So that's another layer
Yeah.
that comes in, which usually is not uh, as well analyzed or discussed when you are doing a seed, pre-seed, or a Series A.
Yeah, certainly. And let's talk about the exitability, right? So, what are the usual kind of exit paths that companies at that stage are looking at? Is that mostly IPOs or is it M&As, right? So, what are the different kinds of paths that are there that startups can be targeting as an exit
I
option?
think there are three different paths, and probably the most uh, slender one amongst them would be an IPO, because you have to the size scale required to get to be a reasonably covered company is much larger. So, barring a handful of the companies that can get there, uh, the other two large options that are there are essentially a trade sale for people like us, wherein we sell our ownership to larger PE funds, who will then take these companies and build them into platform plays, probably. This is what TPG did when they bought out our ownership in a IVF company called Nova, Noah IVF, right? They bought that and used that as a platform to buy more assets around it and really take it to the next level. I'm assuming they would probably sell it to a strategic or list that company in the future. We have already exited that company, but that's one avenue available. And I think with the kind of dry powder that is sitting on that part of the value chain, that's a very viable opportunity for a lot of the early to growth stage funds like ourselves, where we sell off our ownership to these larger funds who will then change the trajectory once again for some of these companies. The other one is a classic trade sale. We instead of so in case say for example in First Cry, we sold off our ownership to a bunch of PE funds, right, who wanted to take ownership and be there in that journey of the company from that point to the next logical point. The third, obviously, is strategic in that context. And again, it's not a very easy market to get strategics or strategic transactions to happen. We did that in our fund one with a company Value First. That was an inbound strategic acquisition that happened during COVID. Classic case of being able to do this without much physical intervention. Very rare to happen. But that's obviously a choice. But that choice also depends upon the founder aspirations as well, right? The founder has to also think that this is the right time for him to monetize his investment, blood, sweat, alongside the investors. So, so if everybody's aligned, then that becomes a great alternative. More often than not, international strategics who still want to build an India play are better partners. I guess the Indian large corporate ecosystem is still warming up to the idea of paying the right price for assets that have uh, built reasonable large size in domestic markets.
Right, absolutely. So you've been an investor in companies right from Naptol to First Cry, right? So that's covering an entire generation of Indian startups or businesses, right? Naptol was one of the very earliest startups that was out there, right? If you call it that, and First Cry being maybe one of the latest, right? So, how have you seen the Indian startup ecosystem mature in terms of the size and the kind of opportunity that there is? and also lastly covering the exitability of the companies, right?
Sure. And I guess there's my first brush of this was in 2007 when I was at ICICI Venture. We did some very interesting investing there, including one of the first payment tech companies out of India. Uh, and again, from that point on to I think 2023, what has changed significantly is entrepreneur quality. I guess the kind of entrepreneurs that are coming into even the seed, pre-series A, series A, VC obviously is much better, is of a different level altogether. I don't think there's any naivety left. These are individuals or teams who have worked in those spaces, built businesses, and are clear on what is the value proposition they want to create over the next, say, 8 to 10 years or right. So that quality of entrepreneurs has significantly grown up. I think a few notches from say way back in 2006 7 to 2023. The other thing that has significantly changed is the Indian economy itself. Uh, the size scale of markets have been transformational, which essentially means that it is possible to create much larger businesses now than what was possible to create in 2007 or 15 or even say 3 4 years back pre-COVID. So that has been a very large driver. I think at least that's the reason why we are all excited at MegaDelta. We believe that this is a multi-decadal opportunity. As Indian economy continues to grow, we will have very, very large markets being available in subsectors, not sectors. Earlier, consumer used to be a sector. Now we are saying that there will be subsectors which would be very, very large, and therefore ability to build large businesses would be there. So that's a market context. The third thing is been very interesting, which if somebody would have told me in 2009-10 as well, I would have said I don't think so. Is the availability of the kind of capital. Uh, I had never thought that way back in 9-10, and maybe I was naive as well at that time, that $100 million checks would be just handed around to companies over a month or 2 months of discussions, and not even diligence, right? So those kind of
Yeah.
those basically change the nature of investing as well. The hedge funds moving into venture capital, private equity markets. I don't think uh, that I do think that's transformational as well, because that has pushed funds like us to also rethink about how we invest, what is the kind of capital structures and scenarios we should be mindful of as we build towards much larger opportunities. And therefore, the ambition that founders can also have is much larger because the capital availability is at a different order altogether. I think last one, and again, this is something that obviously because of the sector I invest in uh, is I believe is completely been transformational is democratization of tech as we speak. The same technology platforms that you want to build a product on is available in the US as in India. Uh, Indian engineers are no less uh, capable of crafting products out of those same technology platforms. And the price and cost of that has made it possible to quickly reiterate, make mistakes, find the right product, uh, uh, product features, product applicability, so that you can get much closer to your customers in terms of what they need and what your product delivers. So that the democratization led by cloud, led by common applications available, has ensured that businesses out of India can also deliver to a very, very large local market as well as near shore and offshore markets as well, including the developed markets. So that's again something I did not anticipate honestly in 2009-10 that it'll happen at this faster pace. In fact, COVID probably has accelerated that by 5 7 years, if not more, both domestically and internationally.
Yeah, certainly. And another important aspect right now in the the entire investing sphere of startups is the downturn that we are seeing, right? The funding has kind of paused, and especially that's especially true at maybe the later stages of funding, like maybe the earlier stages are still going through, but it's getting harder to raise maybe series A's, B's. So since you sit at that point, uh, how have you adapted to the changes in the funding environment? Have you slowed down funding? Is there more diligence that happening? So let us know what's your perspective on it.
Yeah, a bunch of my portfolio companies are in various stages of being in the market or about to hit the market. So I'll speak from that perspective as well. Clearly, there has been a slowdown in the at the pace at which investments used to happen, and I would think these are because of a couple of factors. One is a very macro factor of saying that look, cheaper money is no longer available. uh, Earlier, you were incentivized to take risk because your risk-free rate, which is USD rate, treasury rates were sub 1%, right, almost close to zero. So it was there was full incentive to go ahead and take much higher risk for even a lower return. Now that those interest rates have moved up, from a asset class perspective, you will have to work a lot more harder to generate the returns to beat that risk-free rate. So that essentially means that you would raise a higher bar on the kind of companies one would invest in. So that's one macro factor. The other factor is that look, a lot of investments happened over the last 2 years. So I think funds are still trying to figure out, and a lot of that investment happened hoping and thinking that the easy capital uh, availability will remain. So as this pipe has become a trickle, or the water from this pipe has become a trickle, funds are reassessing their own portfolios to figure out which one needs more help and which one would need more capital and what kind of capital and so on and so forth. So what that essentially has meant is that lesser time to look at newer opportunities, since funds have been more inward looking, and B, reallocation from new investment bucket to follow on bucket, wherein they would like to keep a larger part of their capital aside for such follow ons in the existing portfolio. So it's been a combination of these two factors that has led to a slowdown, I guess, from whatever market commentary is there. There's enough dry powder that is there. So it's not a matter of whether this will come back or not. It's a matter of timing. But I guess a bit of it was also long overdue. We had been seeing a lot of capital being invested around in models that were yet to prove a lot of the say even a product market fit, for example. And we've seen companies raise very very large amounts of capital without proving that, or for that matter, unit economics and the very basic tenets of investing in some sense. So I think some bit of that coming back is a welcome news. I think it will keep entrepreneurs and investors both disciplined. Uh, but I guess
Yep.
how long will it last is anyone's call. But it has to come back because I guess the growth curves, the right companies will demand investors to relook at their investment thesis, come back to the market, and back them. So yeah, we should probably hope that it comes back. From our perspective, it's probably one of the best times to be having capital and to be ready to deploy. It is a completely buyer's market. We can pick and choose the spaces. Uh, the way we invest is both top down and bottoms up. So we have our own sector thesis, subsector thesis, and then we start meeting assets across that subsector to figure out which one is the best that we can put in our dollars to work in. So in this market context, it's probably one of the best times to be sitting uh, aside and evaluating such opportunities. Uh, from our from our perspective, the other thing that happens is we usually take our time to do our diligence. We wouldn't be one of the guys who can write around a check in a month. So such kind of a market environment also helps so that we are able to do our due process. We have walked away from deals in the past where there wasn't enough time to do DD. So we can do what is rightfully required to be sure of the risks that we are undertaking. So that ways I think it's a great market environment to be in with cash on the sides.
Yeah. Yeah, certainly. I think that that's a great perspective to end this with, that capital is still available for the founders who are building great products, and with the focus on the basics of the business, which is unit economics and like profitability. Like if you have all those things in sight, then there is money for you, right? Great. So now let's move on to the rapid fire round, wherein I'll ask you five quick questions about the fund and you have to give five quick answers.
Yeah.
Great. So the first one goes, what are the sectors and regions you invest in?
Consumer, healthcare across different subsectors, tech, including the dash tech companies like fintech, edutech, all of that. Region is India. We are India focused. It could be build for India or build in India for the world as well.
Great. And what's the typical stage you come in at?
Series B onwards, and depending on the subsectors, we calibrate it to maybe a C or a D as well. But our typical one would be Series B plus.
Great. And what's the typical check size?
On the lower end, $8 to $10 million. On the higher end, maybe around 20 million. Median of around 15 odd.
Great. And where can founders apply for funding in case there is a direct way?
Write to us. Our emails are there available on the website. Sometimes LinkedIn also works.
Sure, that works. Lastly, where can our listeners follow you?
We are not as vocal, but we are there on Twitter. Not as vocal, not as much sharing that we do on Twitter or other social media platforms. So yeah, follow our website or press releases.
Sure. For sure. So I'll make sure to put all those links in the show notes below. Thanks so much for coming on, Ruchir, and sharing your insights on how the investing happens on the growth equity side. Thanks for coming on, and happy investing.
Thank you, Prashant. Hope your listeners would find this useful. And yeah, happy investing to all of us. Thank you.